Hello, everybody. Welcome back, entrepreneurs. Today's topic is crucial for your long-term financial health, retirement planning. As business owners, it's easy to get caught up in the day-to-day operations and forget about our future. Let's explore how you can plan a tax-smart retirement today. And I hope you guys enjoyed your Thanksgiving or your day off or your holiday, whatever it is. And it's Friday now. Don't do too much shopping. Let's get back into some retirement. But before we do that, let me introduce myself. So my name is Shane Harris. And around here on these social media platforms or these social media streets, I'm also referred to as Shane the Negotiator. And I help coaches, consultants, and service providers who are overwhelmed and lack guidance to achieve true financial freedom. And I do that by providing expert tax and coaching services. That's what I do, and that is who I help. So today, as I said, we're going to be talking about tax smart retirement, planning your future today. Let's get into some understanding what retirement plans are. So retirement planning is about setting aside funds today so you're financially secure when you stop working or you stop running your business. For business owners, this also means considering the tax implications of your savings methods. The goal is to increase your retirement savings while decreasing your tax burden. So let's talk about some retirement accounts for business owners. So there's several retirement account options for entrepreneurs. Traditional and Roth IRAs offer individual savings, while SEP-IRAs and solo 401ks are great for self-employed individuals. Each has its tax advantages for tax-deferred growth to tax-free withdrawals. So let's talk about some SEPs and solo 401ks. So SEP-IRAs allow you to contribute a significant portion of your income, making them ideal for high earners. And the solo 401ks, on the other hand, offer higher contribution limits and the option for a spouse employed by the business to contribute as well. That's a nice little touch, isn't it? Both can be excellent ways to save for retirement while reducing your current taxable income. Now, I know you guys love finding ways to save on taxes. This is it right here. This goes into a part of tax planning. So let's go on into a case study before I pull up the chart and do some explanation for you guys. So, case study on maximizing contributions. Let's consider the case of Julia. Julia is a freelance graphic designer, and she opted for a SEP IRA, which allowed her to contribute 25% of her income, significantly decreasing her taxable income. Over the years, this not only saved her money in taxes, but it also built a substantial retirement fund for her. So let me go ahead and pull up my chart that I created for you guys, and then we'll get into some more of this topic. So let me go and open up my screen a little bit more. So here's a nice little chart that I created for you guys so I can explain things for you. So I think it was last week, Monday, we actually, or maybe it wasn't last week, Monday. Yes, it was last week, Monday. We were speaking about LLCs versus S corporations, and I gave you the breakdown or showed you the breakdown on what it means if you had a revenue of 500K for both types of business with your expenses, the owner's draw or salary, the taxes, what is going to be your take home, what is going to be your taxable amount at the end of the year based on certain expenses that you have. So I'm not going to go through this entire chart again. I'm going to move on to the second one that is really going to talk about the retirement planning. So if you did not catch that previous recording last Monday when we were speaking about comparison between LLCs and corporations, go back and catch that video, and I'll drop the link at the end of this video or this recording. Is going to have either the link's going to be on this side or it's going to be on this side. I don't remember which one, but I'll have the link so you can go back and catch that previous recording so that you can see this. So just a brief overview. We have a revenue. This is a LLC, business A. S corporation is business B. Both of them have a revenue of $500K. They both have expenses of $300K each. Owner's draw on an LLC is $60,000. There's no owner's draw for S corporation. Owner's salary for LLC is not applicable, but owner's salary for S corporation is $60K. Payroll taxes for LLC, there is none. There's also $20,000 in payroll taxes for this business owner. Now, this is not taxes particularly for this $60,000. I just made up a $20,000 number just to kind of show you the difference. So business profits equals revenue. Business profits minus the revenue minus expenses minus salary equals the business profits. So since the LLC cannot take an owner's pay through W-2, they cannot be on payroll, they do not have any of the salary or payroll taxes, and this $60K gets passed down to the member to file on their personal taxes. So this is considered profits. Whereas business B, this S corporation, they took $60,000 in salary and payroll taxes. So this reduces their profits by $80,000. So they have $120,000 remaining in profits that that passes through to the individual shareholders to file on their personal taxes. Okay, so hope you guys got that so far. So I went ahead and I just made the federal tax rate for a single filer. I didn't want to go through all the tax rates, and I did not use self-employment taxes. I just used income tax for this example. So 32% of a $200,000 in profits, that is the tax. In $200,000 in profits, the tax rate is 32%. For the S corp, $120,000 in profits, the tax rate for $120,000 is 24%. The total taxes paid for the LLC is $64,000. The total taxes for the S corporation is $28,000. So as you can see, it's the LLC versus the S corp. The S corp is more favorable for this particular example. So let's go on to estimated tax paid each for the estimated taxes paid, and then for each quarter is $16,000 for the LLC, $7,000 for the S corp, and that is $64,000 divided by 4. Every quarter, they're going to have to make an estimated tax payment for $16,000. For the schedules for the S corporation, $28,000 is the total tax. So each quarter, they're going to pay $7,000 to the IRS for estimated tax payments. Now, the S corp is not actually paying the taxes. The individual, the shareholder, they are paying the taxes because the business of itself generally do not pay taxes. So let's go on to, now that I have give you a recap on this, let's go on to slide 2 and really get into the comparison for the retirement plans. So this is our retirement plan chart, and we're using the same business. Business A is the sole proprietor and the LLC. Business B is the S corporation. So we're going to go back again. The total revenue for both of these businesses is $500K each. The expenses, including the wages, is $300K for the LLC, $380K for the S corp. Why is it different? Because the LLC cannot deduct what they paid themselves, which was $60,000. That was added to the profits. Business B paid themselves $380K because they had $60,000 in wages. They ran through payroll plus the $20,000 in payroll taxes. So that's why they have $380K in expenses, because those wages and the payroll taxes is an expense. It's you can write it off. It's deductible for S corporation. So the total business profits for an LLC, business A, is $200K. For business B, the S Corp is 120K. So we're talking about retirement plans. And for this one, I just chose a SEP-IRA. The 401K and all of those others can be a little bit different, but I just chose the SEP, and I put 50,000 as the contribution that both of these business types contributed to their retirement plan for the business. So 50K for business A, 50K for business B. So this is in parentheses because even though it's money, green means positive and it's a positive number, we're saving it later for retirement. So it's being subtracted from your account, but it's going into your retirement for later. So we're subtracting 50K from 200K, and the profits is going to be 150,000 for business A, which is a sole proprietor or a schedule or a LLC. And this is the amount that is going to be taxable when it passed through to you to file on your personal taxes using what's called a Schedule C. For business B, you had 120,000 in profits. You put 50,000 into your SEP retirement plan for later. It reduces your business profits for tax purposes to 70,000. You're going to take this 70,000, the business is going to generate a Schedule K1, and you're going to take that K1 for each shareholder in the business. If you're the only one, that is, you're only going to get one. If you have 2 or 3, then each person is going to get a Schedule K1 based on the percentage that they own the business. So the 70,000 is going to pass through on that K1 to you, the individual, the shareholder, to file on your personal taxes when you do your taxes. So again, I'm using the federal tax rate for a single filer, and I just went ahead and I used the income tax rate. I did not use the self-employment tax rate. I'm just making it a standard tax rate across the board for everybody. So for easier math, instead of going through too many complicated situations. So based on 150K in profits, in revenue, in income, 24% is the tax rate for 150,000. For the S corporation, business B, 70,000 is the income, is the revenue, is the profits. 22% is the tax rate for $70,000. And this is the 2023 tax rate schedule I'm getting this information from. So the taxes paid, the total taxes paid, if you're a sole proprietor or if you are an LLC filing your taxes on what's called a Schedule C, would be $36,000. So that is half the amount from the previous slide when you were paying $64,000. So here it is. We went back. $64,000 was what you originally paid. But if you invested that $50K into your retirement plan for later, you still have that money. It's still yours, but it reduces your taxes to $36,000, half the amount. For business B, the same applies. The total taxes paid is $15,400, reducing it by almost half because it was $28,000 previously when we did not have the $50,000 going towards the retirement. So after you invested into your retirement plan, your SEP, $15,400 is your total taxes paid now. So the quarterly taxes that you're going to pay as a business A would be $9,000 every quarter versus on the previous slide where you was paying $16,000 per quarter as reflected here. And for business B, originally they were paying $7,000 every quarter towards their estimated tax payment or to pay their taxes. And now they're paying almost half the cost of $3,850. Now, I don't know about you, but I know if I made $500K in my business and I'm only getting taxed on $70,000, that is a good year for me. I would much rather make $500K, pay into my retirement plan, write off almost all my expenses, and pay 70K, pay taxes on 70,000 versus having a business where I made 500,000, wrote off 300 in expenses. I could not deduct the additional 80,000 because I paid myself or payroll taxes because I do not have that business type. So instead of paying taxes on 70,000, I get to pay taxes on 150K. I would much rather pay taxes on 70,000 instead of 150,000. So this is the breakdown on what it can look like if you have two different business types, the LLC versus an S corporation. And once you start contributing to your retirement plan, this is essentially what it can look like for you. So that is the example that I wanted to give. So let's go on back to our slide to continue on with the rest of this. So just give me 1 second to get my screen back to where it's supposed to be. Okay, now we are back. So I hope I explained that for you guys to really understand the difference. And of course, if you have any questions or you need me to break things down a little bit more, you can always schedule some time and sit down with me and I can assist you with that as well. The link is in the description, but I'm also have it rolling across the screen at this time. So let's go into the importance of diversification. So diversifying is a key in retirement planning. So essentially, you don't want to put all your eggs into one basket. You want to have a mix. You want to mix your tax-deferred accounts like your traditional IRAs with tax-free accounts like those Roth IRAs. This mix can offer flexibility in managing tax debt during retirement. So let's go into some common pitfalls to avoid, some common situations to try to stay away from. Avoid the common mistakes such as overestimating your ability to save later in life or underestimating post-retirement expenses. Start as early as possible and be realistic about your retirement lifestyle and its costs. So I hear it too often, more times than I care to admit, that I have clients that I come and I sit with, or I speak with some of my other colleagues and we have conversations around this topic, and we hear our clientele are saying, I'll just save a little bit later. I'll, work hard and do what I need to do right now, do what I need to do with the money right now. And then in about 5 years or 10 years, I'll just double down and put this extra amount towards retirement. Or they may not even know, or I have some of those older clients who are getting closer to that time of retirement, or they had just retired from their business or their employment, and they realized they didn't save enough. When they did their retirement planning or their planning for the future 10 years ago with whatever the lifestyle that they had at that time, now it's 10 years later, they may have a different lifestyle, and the amount of money that they set away for retirement may not be enough to cover the lifestyle that they want to live right now today. So that is some of the common mistakes that business owners and entrepreneurs make when it comes to these retirement plans. Retirement is not only for large businesses or large corporations. If you are a sole proprietor, meaning you have a 1099 that you're using your EIN number or your social security number, or you're getting paid as a 1099, an independent contractor, or if you're an LLC just now getting started, you can contribute to a retirement plan for your business. You do not have to be a corporation like an S Corp or a C Corp. You can just get started with your S Corp or your C Corp like 5 months ago, 2 days ago, and you can still set up the retirement plans for your business. There's limitations on how much you can contribute each year based on the retirement plan that you choose. Of course, a financial advisor would be able to assist you a little bit more with picking out and choosing the right retirement plan for you and your business. I am not a financial advisor, but I can recommend a financial advisor for you to work with should you need one. So if you have questions about this topic that we're speaking about in retirement plans, you can schedule some time with me to sit down and we can talk a little bit more about it. And I can directly schedule an appointment for you to sit with that financial advisor to really talk about what it means for your particular business. Okay. So planning beyond saving. So retirement planning isn't just about, it's not about saving money. That's not the only reason why you have retirement planning. It's also about planning for business succession and ensuring a smooth transition when you decide to step back and decide that you don't want to do this anymore. You want to not be the CEO anymore and step out of the limelight. This is what the retirement planning is all about. So to wrap this all up, securing your financial future requires foresight and planning, especially when it comes to retirement. Start today, make informed choices, and watch your nest egg grow. So a little bit of teasers for the next topic that we're going to have, which is one of my other favorite topics. I got a couple of good topics that I love, and one of them I'm going to be talking about next week, which is we are going to dive into profit first methodology, a transformative approach to managing your business finances. Stay tuned for Profit First Financial Health to learn how prioritizing profits can change the game of your business. So it's another fancy word for budgeting. We're going to be talking about budgeting and how to use the profit first method of accounting to really scale and grow your business and stay on budget. So to wrap this all up, thank you guys for joining me today. Remember, it's never too early or it's never too late to start planning for your retirement. I want you guys to like, share, and subscribe for more insights into making your business and personal finances thrive. Until next time, plan well and prosper. And don't forget to check out the link. I'm going to have it one of these sides. I'm going to have that link for you to go check out the previous recording that I made on the difference between the LLCs and the S corporations so that you can really get the deep down dirty, the skinny on that particular topic. So until I come back on Monday with another nice fancy topic, I hope you guys have a great and wonderful weekend. Well,